joining us from Washington, D.C., we have Steve Bartlett, President and CEO of the Financial Services Roundtable, which is a trade group representing some of the biggest financial firms in the U.S. Good to have you with us, Steve. Okay, so here we have it. It is law now after being signed by President Barack Obama. Now, of course, there's been a lot of criticism about this overhaul. We have the U.S. Chamber of Commerce saying that it's nothing more than a financial regulatory boondoggle, which doesn't jumpstart the economy, doesn't create jobs, and doesn't strengthen the markets.
Well, you've now seen what we have to deal with here, Susan. I take more of a middle ground. I think it both has some good news and some bad news at the same time. The good news is that it's done. We can turn the chapter. We can put some additional certainty into the market and have an idea of what the rules are going to be going forward. So it ends that uncertainty and lets the industry go back to financing the economy. It also has some pretty good stuff in it. Systemic risk regulation. We believe it will end too big to fail. We believe that's true. Good lending standards. On the other hand, it's got some really bad stuff in it. Limitation, price controls on debit cards, and some derivative items that looks like it's going to clog up the system on derivatives. So the regulations will do a lot to find out what it really turns out to be. But right now, it's good that it got done and to get us behind us so that we can get on with our business.
Yeah, okay. So, Steve, talk to me about costs for the banks because, you talked about financing the economy. Some are criticizing this bill as hampering credit and the delivery of credit to the markets and the economy.
Well, as a financial institutions, financial services industry, we have to pay for it. So that's a given. And as you know, you put in all your costs, and then at some point the consumers end up paying. But that's not the real cost. The real cost is if this is done badly. That is to say, if the regulations come out badly in derivatives and in capital and in proprietary trading, you could end up damaging consumers because you'll have a loss of credit. There's some estimates that you could lose as much as $1 trillion of credit overall. I think it won't be that much. I think that's too big an estimate. But whatever limitations you put onto extending credit, you're going to get less credit out of it. So time will tell. A lot of this bill we'll know more as it is implemented through the regulations. So a lot of it has to go through the regulations, and we'll know more in 3 months and 6 months and a year and 2 years. But for today, it's a good day to be able to put it behind us so that we can get on with our business.
Yeah, and Steve, let's talk about the consumers because part of this bill is to build up this consumer protection agency, right? And they're trying to fend off what they call egregious acts of doling out credit by the banks to consumers. Do you think this actually benefits the Americans who hold credit cards and are looking for credit?
Well, we as an industry, we've sort of come to grips with the fact that we want more and better consumer protection. One of the things that happened during the last crisis is there's this whole shadow banking system that's not part of mainstream regulated banking, and that shadow banking system in many ways did in fact abuse the consumers in many ways. So one of the good things about the bill is it would impose consumer protections on the entire provision of credit for everyone. It's not clear whether the Consumer Protection Agency, what they will end up doing. Their mandate is pretty broad, and probably the worst thing about it is it's not tied to safety and soundness. And that creates a problem, and we'll find out in a year or 2 years or 3 years how big a problem. But if you have an agency that says make this loan for consumer protection, another agency says don't make this loan for safety and soundness, then you have a real problem and you could have chaos in the system. So we're going to make it work.
Clarity, Steve.
We endorse
let me just quickly talk to you about.
Yeah, sure.
Yeah, let me talk to you about clarity because a lot of people criticize this bill as being lacking in clarity. There seems to be no distinct rules here. In the end, after this implementation, is this enough to prevent another repeat of the 2008 financial crisis?
I think so. I think that's the good part about it. The financial crisis at its heart was based on bad loans. That is companies making bad mortgages without the ability to repay, securitizing them and sending them upstream and putting them into pools, and then they were still bad loans. And there was no systemic regulation of that. That is to say, a state-chartered bank in Alabama would notice it's a bad loan, but they didn't regulate the loan. They just told the bank they couldn't own it. And then the loan would be sent up to Wall Street, and it would be packaged and securitized and then insured by 50 states. And it was a really chaotic mess. So the best thing about this is it does create a systemic oversight agency to where all the regulatory agencies are required to talk to each other and to provide for systemic protection. So that's the good news about this this bill. There's always going to be a crisis sometime in the future, but I think this crisis, what led up to this crisis, I think this bill does put it behind us, yes.
Okay, Steve, thank you for that. Steve Bartlett, President and CEO of the Financial Services Roundtable.